What is yen carry trade? The yen carry trade is a financial strategy used by investors to capitalize on Japan's low interest rates. Here's a breakdown of how it works. 1. Borrowing in yen. Investors borrow money in Japanese yen, benefiting from the country's historically low interest rates. 2. Investing in higher yield assets. The borrowed yen are then converted into another currency and invested in assets or instruments with higher yields, such as bonds, stocks, or real estate in countries with higher interest rates. 3. Profit from interest rate differential. The strategy relies on the difference between the low borrowing costs in Japan and the higher returns on investments elsewhere. Investors aim to profit from this interest rate differential. 4. Currency risk. One significant risk in the yen carry trade is the fluctuation in exchange rates. If the yen appreciates significantly against the currency in which the investments are made, the cost of repaying the yen-denominated loan can increase, potentially offsetting the gains from the investment. 5. Market impact. The yen carry trade can influence global financial markets. Large-scale unwinding of these trades can lead to significant movements in currency exchange rates and affect market stability. Overall, the yen carry trade is a strategy that leverages low interest rates in Japan to seek higher returns abroad, but it comes with risks, particularly related to currency fluctuations. Recent yen carry trade blowback. Japan kept interest rates ultra-low for decades following the collapse of an asset bubble in the 1990s, which contributed to persistent deflation. Recently, the Bank of Japan surprised markets by raising its interest rate from near zero to 0.25%. This unexpected move has caused the Japanese yen to strengthen significantly. The rapid strengthening of the yen has resulted in substantial losses for those engaged in yen carry trades. As the cost of borrowing in yen has increased, the profitability of these trades has diminished. Impact on global market. The Nikkei 225 index, Japan's primary stock market benchmark, plummeted by over 12% in a single day, marking its worst decline since the 1987 Black Monday crash. The reverse carry trade was a major concern for the U.S. as well, with the S&P 500 declining by 1.8%. South Korea's Kospi and Taiwan's weighted index experienced significant declines, with both indices falling by more than 8%. Impact on India's market. Despite global market volatility, the Indian markets have remained relatively resilient. On August 5th, the Sensex closed 2.74% down, while the Nifty 50 dropped 2.68%. The Indian markets are now more balanced, having recently navigated major events such as elections and the Union Budget 2024. Way ahead for investors. 1. Shift to high-quality stocks. Investors should focus on companies with strong fundamentals and sustainable growth, moving away from low-growth, low-quality segments. 2. Orientation towards large caps. Prioritize large-cap stocks for their stability and resilience, especially during market volatility. 3. Selective exposure to mid-caps and small caps. While large caps should dominate your portfolio, consider quality mid-caps and small caps with strong fundamentals and growth prospects. 4. Monitor global events. Stay aware of global factors like the unwinding of the yen carry trade, U.S. recession fears, and Middle East conflicts that may cause market volatility. 5. Rebalancing portfolios. Reassess and rebalance your portfolio to emphasize quality and growth-oriented investments amid potential underperformance of certain sectors and global market volatility.